credit report information who wants it. It is becoming increasingly important to have an acceptable credit record whether we like it or not. Society equates the ability to manage credit responsibly with responsible behavior. Even if individuals have a bad credit record through no fault of their own. Landlords, if individuals have a bad credit record through no fault of their own, landlords often look at applicants' credit records before renting apartments to see whether they manage their finances responsibly and are therefore likely to pay their rent on time. Banks and other lenders look at the credit records of loan applicants to find out whether they are likely to have loan repaid. Some employers also look at credit records, especially where employees handle money, and view a good credit record as a measure of maturity and stability. In some insurance companies, underwriters have long used credit records in case where additional information was needed before the development of automated scoring system. Underwriters would look at the data and make decisions, often erring on the overly cautious side that disadvantages many more people. Automated insurance scoring and underwriting system eliminate the weakness inherent in someone's personal judgment and have allowed more drivers to be placed in preferred and standard rating classification, saving the money. With the development of these scoring models, the use of credit related information in underwriting and rating for many insurers has become routine. Insurers use insurance score to different extents and in different ways. Most use them to screen new applicants for insurance and price new business. Why insurers need it? Insurers need to be able to assess the risk of loss, the possibility that a driver or a homeowner will have an accident and file a claim in order to decide whether to insure that individual and what rate to set for the coverage provided. The more accurate the information, the closer the insurance company can come to making appropriate decision. Where information is insufficient, applicants for insurance may be placed in the wrong risk classification. That means that some good drivers will pay more than they should for coverage, and some bad drivers will pay less than they should. The insurance company will probably collect enough premiums between the two groups to pay claims and expenses, but the good drivers will be subsidizing the bad. By law, in every state, insurers are prohibited from setting rates that unfairly discriminate against an individual, but the underwriting and rating process are geared specifically to differentiate good risk from bad risk. Since insurance is a business, insurers favor those applicants that are least likely to suffer a loss. One of the key competitive aspects of the personal lines insurance business is the ability to segment risk and price policies accurately according to the likely cost of claims generated by those policies. Insurance scores help insurers accomplish these objectives. Earthquake risk and insurance issues. An earthquake is a sudden and rapid shaking of the earth caused by the breaking and shifting of rock beneath the earth's surface. This shaking can sometimes trigger landslides, avalanches, flash floods, fire, and tsunami. Unlike other natural disasters such as hurricanes, there are no specific seasons for earthquakes. Earthquakes in the United States are not covered under standard homeowners or business insurance policies. Coverage is usually available for earthquake damage in the form of an endorsement to a home or business insurance policy. However, insurers that do not sell earthquake insurance may still be impacted by these catastrophes due to losses from fire. Following a quake, these losses could involve claims for business interruption and additional living expenses as well. Cars and other vehicles are covered for earthquake damage under the comprehensive part of the auto insurance policy. In the United States, about 5,000 quakes strike each year. Since 1900, earthquakes and occurred in 39 states and caused damage in all 50. One of the worst catastrophes in U.S. history, the San Francisco earthquake of 1906, would have caused insured losses of $96 billion. Where the quake to hit undercurrent economic and demographic condition according to AIR worldwide. The potential cost of earthquake has been growing because of increasing urban development in seismically active areas and the vulnerability of older buildings which may not have been built or upgraded to current buildings code. The Northridge earthquake, which struck southern California on January 1994, was the most costly quake in U.S. history, causing an estimated $20 billion in total property damage, including $12.5 billion in insured losses. In its wake, the California Earthquake Authority (CEA) was created in 1996, fearing insolvency from another massive earthquake. The vast majority of insurers in the state's homeowners insurance market had severely restricted or ceased writing coverage altogether after Northridge to ensure the availability of homeowners coverage and a serious threat to the vitality of the state's housing market. The California legislature established the CEA as a publicly managed, largely privately funded entity. Only about 12% of California now purchase earthquake coverage, down from about 30% in 1996, when the devastating 1994 Northridge quake was still fresh in people's minds. To encourage more Californians to buy the coverage, the CEA approved an average 22% rate cut, which went into effect July 2006. The CEA says that a sharp drop in the cost of reinsurance and several years without a major quake, allowing the build-up reserves, made the cut possible.